Well, it would depend on whether that other money tree sits inside your organization or outside your organization. So if it's inside the organization, then that all gets handled on the balance sheet and the P&L to see what those different money trees are. So that becomes different classes, departments, locations, business units, or if you set up a separate business, then that becomes two businesses run side by side or two financials run side by side, and then you consolidate those two.
This is Chris G here, Hard Hat the CEO, and another episode. And today, while y'all know I love talking about real estate, probably the second best thing I like talking about is numbers. Looking at those profits, figuring out what's going on, what's it telling you. And I have a special guest all the way from Southern California, Ken LaCroix. Ken is a CFO. And I talk a lot about being a CEO, but if you're a CEO, you need a CFO to help you look at that stuff. And if you don't have enough money for that, then you got to be the CFO for yourself until you grow big enough. But to help me, please welcome Ken LaCroix. Ken, how you doing today?
I'm doing great, Chris. How about yourself?
Doing fine, doing fine. Tell me real quick what the CFO does for the people who don't know.
Sure. So a lot of people sort of confuse finance and accounting together, but CFO, Chief Financial Officer, we sort of run the finance side of the accounting and finance equation. So we don't necessarily produce the numbers, we sort of interpret the numbers and do all kinds of things around the business as well as in the business. So think strategy, think capitalization, think interpretation, and just really try and help the business owners and their management teams understand the numbers so they can make better decisions, hopefully with data in addition to their gut.
How often, well, I think I know the answer, but how often should somebody look at their numbers?
Well, we think there's things you should look at daily, there's things you should look at weekly, and things you should look at monthly. So the short answer is the more frequently, the better, and the more condensed and the more specific, the better. Very
good. So a daily would be like what the KPI, which is the key performance indicator.
Sure. Think about, which of my jobs are ahead of schedule, which are behind, which are ahead of budget, which are behind, which have change orders outstanding. Anything that helps direct your action to the most impactful thing you can do in the next minute, hour, or day.
Is there KPIs that are standardized for, say, contractors, or is that kind of depending on your business?
Well, so the philosophy here is there's KPIs or numbers that matter to outsiders, and there's KPIs, numbers, or metrics that matter to insiders. And so the numbers that matter to outsiders tend to be a little more standardized. Think of your bank, think of your investors, think of your exit strategy, your valuation. Those tend to coalesce around a set of metrics that help them value all businesses in addition to your own. When we look internally, it's usually a standard set of things around profitability, around capitalization, liquidity, profit, those sorts of things. But then there's always things that we're working on right now. What are the top 3 things that we're looking at to change in the business, and what's the best way to measure that? So if it's grow our sales, then we want to have some metrics and KPIs around what are our salespeople doing? What's the sales function doing? How's that working? If it's to drive profitability rather than sales, then we might not look at sales every day or every week or metrics around that. We might look at profitability around jobs, profit trends, things of that nature.
I was going to ask, because you can get into the analysis paralysis thing, but you look at maybe top 3 you said, or you might.
I like 3. If you can knock out three objectives, 3 initiatives, 3 things, and have time left over, more power to you. Pick a 4th one, pick a 5th one. But what we too often find is that there's 10, 15, or 20, and none of them get looked at, approached, or dealt with sort of the intention that's necessary.
Do you break those 3 down, and I would say 3, by department or by category? For example, if you're wanting to focus on sales, do you have 3 for sales? And if you want to concentrate on production, 3 for production. It might be a different person in charge of both of them. Is that kind of the way to do it?
It's a great way to explain it. So that's the cascading effect down into the different silos or areas of business. So again, there's sort of an overall 3 for the company, and then you can think about within those 3, you can think about 3 in every department that hopefully would align with that. It doesn't always have to, but that usually would align with that from an operating system perspective, if you will. So the whole business is working in the same direction.
So let's say you don't have any KPIs right now and you're starting out new and you're running on your gut. What's the first, how do you make that transition, basically?
So I guess it depends on whether you're looking closely at your financials or not. And I'm not suggesting that everyone necessarily needs to look at their financials all the time. Remember, financials are created for outsiders to understand your business. So I'm okay if you're on the small side of things to look at your business more from an observation, more from a gut, more from a rule of thumb perspective. However, as you grow and as complexity creeps in, it becomes harder and harder to rely only on that. So that's where we like to introduce the financial statements, call it the profit and loss statement, the balance sheet, cash flow statement. But again, those are all big generalities and a collection of averages. I think for me, I like to introduce what we call non-financial KPIs, where we're taking things from the financials, the balance sheet or the income statement, and we're tying it to an outside number that helps give those financials more relevance. So my sort of first step, my gateway drug to KPIs is a number per employee. And so the first one we started with is revenue per employee. So just count the number of employees that you have at the end of any given month. If your pay periods don't end on the end of the month, don't worry about it. Take it the last pay period of the month. Make it simple. Introduce the concept of full-time equivalents. So if you have 5 people that are full-time and 2 people that are part-time working half the week, you basically have 5 plus 0.5 plus 0.5, which is 6. So the FTEs is important to know the full-time equivalents, and then take your revenue and divide it by the number of FTEs that you have. That will tell you over the last 12 months, 36 months, 48 months, 5 years, it'll tell you how your sales are doing in proportion to your organization. So are you getting more efficient or are you getting less efficient? If your sales go up, but your people go up, that could be a problem. It might not be a problem, but we have to look at it that way. It's a good way to gauge it. And once you've done it for revenue, do it for gross profit. Once you've done it for gross profit, do it for net profit. The reason I like that is because it also normalizes for raising prices. Sales go up when you raise prices. Profitability doesn't necessarily follow if your costs are outstripping your price increases. So for us, that gives us a really good sense of where the business is headed from a organizational efficiency perspective or an operating leverage perspective. And it lets us know if we need to focus on revenue, focus on gross profit, or focus on net income. And by the way, those are your first 3.
Well, let's say I've got these numbers or getting those numbers, and what do I compare them to? Because, back in the day, it used to be associations. I mean, there's still association, but I used to get a list of, here's what your other people are doing from a blind evaluation, and you can always compare it to them. But what do you do these days?
It's tough. It's always been tough. And it's tough for a number of reasons. Number one, private companies don't publish financials. Larger private companies that have debt publish financials to lenders, and those lenders publish those financials, or insurance companies publish those financials. So there are rough guides for larger companies in the $500 million space, $1 billion space, that are still private, and not public, not subject to publishing their financials. And so it's hard. There's also differences in accounting policies and procedures. Some companies are on the cash basis, some are on the accrual basis, some measure this, some measure that. So some update their books quarterly. Sometimes they only update the books at the end of the year. They wait till their tax professional gives them a depreciation number and they book it all at the end of the year. Those are all the things that sort of get in the way of too fine of a look at any given number. That's why we sort of like the trends. We like internal trends. How have you been doing? How have you been running your business? What are the trends telling you? And what can you do internally to improve those trends? Because it doesn't matter what someone else is doing. If you are measuring something and you can increase your profitability, you should do it anyway.
No matter. Good point. And it's not fair to compare ourselves to some other companies. And I want to stress that. I'll give an example. We had the profit leader status, and you look at those profit leader statuses, and they tell you one thing, and they tell you, and look at the breakdown of, say, materials, for example. Well, on a smaller company, your material cost might be percentage-wise more than a larger companies buying on mass
Yep.
scale.
Yep.
And it's not fair. I mean, now if you're making money, that's good, and you want to improve that money. And I think it's like you're saying, you have to look down and just find what you are, what you really want to focus on. If you know you've got too many employees or you want to get more revenue per employee, focus on that type of stuff.
Yeah,
We
and
talk.
that's a great
Go ahead.
point, because you may not be able to compete with the larger organizations on a material cost perspective, but you certainly can on a flexibility or a pivot perspective. You
Yeah.
can introduce change immediately. Those larger companies, very hard to change. You can respond to the marketplace very quickly. You can respond to your customer very quickly, your supply chain very quickly. So your advantage doesn't lie in necessarily the cost side of things, but in terms of flexibility and ability to pivot all day long and utilize those.
What we found was while we couldn't compete necessarily on the materials, our sales per employee was blowing them out of the water.
There you go. Great
And
example.
that was, because we're small, we're nimble, that type of stuff. Where their answer sometimes just hire more people, and that's
Yep.
not a good answer in my opinion. But that's what size you are. And I'm not trying to keep people out of work, but you know what I'm saying. It's a philosophy that you got to get more of what you got.
The, the company needs to be sustainable to keep those jobs in place.
Absolutely, keep the jobs you got and keep them guys busy and take care of those employees. You talk a lot about vanity numbers, and can you give me an example of a vanity number? And then, but they don't really drive profits necessarily.
Well, vanity numbers come into play when we talk about this concept of lonely numbers as well. If I tell you that our sales went up by 10%,
Mm-hmm.
I don't really know if that's a good number or not. If my competitors went up by 15%, that's not a very good number. If my competitors went up by 2%, that's an outstanding number. So we like to add, if you will, some sort of reference around the number. So my sales are up 10%, and we thought they would be up 8%, so we're celebrating. That planning component, I thought we would do 8% and we did 10, so we're celebrating. Or I thought we would do 12% and we did 10%. So we're not celebrating, but we're looking for that root cause. What caused us to miss it? Was it a bad estimate? How can we get better at estimating what our sales growth will be? Or was it a good estimate and we just fell down operationally? Was there some aberration? Was there some problem? Problems have variances, I should say, have two issues, two components to them, two characteristics. A variance can be a timing difference or a permanent difference. So if our sales went up by 10%, we wanted them to go up by 12%, and someone said, look, we had a really big job that was supposed to start right at the end of the quarter, and they just pushed it a week. They just pushed it to the first week of the following quarter. I'm okay with that because I'll make up the difference next month. But if the reason we hit 10% instead of 12% was, yeah, we didn't get that client, or more importantly, we lost a client, that's all hands on deck. So the number itself doesn't matter nearly as much as the number in comparison to something last year, last month, last quarter, next year, our next year plan, our next month plan. All of those things help determine whether you can move on from the number and know that it'll self-correct, or all hands on deck, like I mentioned before. Let's look into this. Let's find out if there's something there.
A couple different questions. Now I'll go back to the next one. But you mentioned something, and I wanted to draw back on that. Your clients, losing a client. You can use KPIs or your financials to look at what clients you don't want, right? As well as you do want.
You touched on the heart of what I passionately believe in, and we think understanding profitability by customer is crucial. And your gross profit and your net income are averages, and you have customers and jobs and cost codes and processes and procedures that have high profitability, average profitability, a little bit of a loss, or a chunk of loss associated with them. And so the more you can focus on the things that are highly profitable and either stop doing the things that aren't as profitable, or discuss ways either internally or in communications with your customer or your suppliers to find ways of making those more profitable and have discussions around them. So understand why there's variation in your profitability, and then understand what you can do about that to drive everything forward.
I did a solo episode a couple of weeks ago about just not taking on clients you don't need to be taking on. You go find the ones you need to, and and maybe you don't know, but through these reports and looking at stuff, you can figure out which ones you're doing better at, and then go find more of them. Um, I never want to. I say never. I don't want you dropping your prices, but if you have to in a competitive place, there's places you can squeeze something out. Maybe your margins aren't there they need to be, and we can talk about overhead and all that good stuff later. But there's places if you have to compete number wise, and it comes down to that, you can decide if you want to or not, knowing what type of customer you're working with. So
there's a couple concepts around that,
yeah,
and I want to stress, when you're first starting out, there's nothing wrong with going after every possible opportunity or job. The issue becomes once you've reached a certain size, what has gotten you here will not get you there. So at some point, you need to change the culture, the DNA of saying, we do everything for everybody, to this is where we focus, this is where we think we can do best, and let's try and focus on that. So it's more a recognition of success, a recognition that you now have enough business that you can be, call it choosy, or you can be somewhat focused and pursue those things, and then unwind or get out of the things that are not as profitable for you. You may still end up doing them for a while, but you can have conversations with your customer about, look, these 7 things we do for you, we do them really well, and we like that. But these 3 things we do for you, we're not making a lot of money on them. So we'd like to open a discussion. And the discussion could go something like this. The customer might say, you know what, we only buy those from you because we want to be loyal. If you're telling me you just want those 7 and not these 3, we'll buy them from someone else, no problem. Or they might say, look, we really appreciate the fact that we have one neck to strangle, one person to grab onto. We love your customer service. If you need to charge us more for those 3 things, go ahead and charge us more. So those are the types of conversations you can have. It's not a blanket, I need to raise prices 5% to cover these losses over here. It's really opening up a dialogue with your customer and with your suppliers as well. Say, look, we're on the same page here. And I think post supply chain shock, pandemic, inflation, whatever that looks like, everyone's more open to a conversation around that. It's far less about a commodity negotiation, and it's more and more about a long-term strategy and partnership with the ecosystem.
I thought we'd come back to overhead. Let's talk about overhead a little bit. How does overhead play a factor in your analysis? And forgive me, does a CFO get involved in the hourly rates of the client, or is that more of the accounting side?
CFO should be actively involved in those hourly rates. CFO should be actively involved in
as sales goes up, and definitely the right sales, your overhead as a percentage of sales should go down.
We call that operational leverage. Yes.
So you play all those games, and that's a discussion you should have with your people, right?
So that sort of fits in this middle ground between financial accounting and finance, and we call it cost accounting, or management accounting, and it's really that internal accounting that I spoke of earlier. But we hold it near and dear to our hearts. We think that's what all businesses should focus on. Your CPA is wonderful to prepare your taxes, to do your compilations, your reviews, your audits, to prepare things for the outside world. But management accounting is what you need to run your business. Now, I'm sort of the anti-overhead guy. I don't like it. I think that you should be focused on direct cost and direct overhead and leave the variable overhead out, because just like no plan survives the first day of war, no overhead allocation survives the first attempt at the activity base. So the concept of overhead, if it's direct overhead, we know that it applies to a certain job or a certain arena, a certain cost code. We know with certainty that happens. So by direct cost, I mean, in this case, it varies with revenue. So if my revenue goes up, I need to add more people to it, then that's a direct cost. Allocate that by all means. But if I have a truck, how am I going to allocate a truck to a job? I can't allocate the wheel, the door, the carburetor, the fuel injector in this case, the air compressor system. So I need to create a base. That base can be activity or cost. And so I can say, you mentioned hours before. I'm going to estimate that cost me $17 an hour to operate. And this job over here took me 15 hours to do. So I'm going to take 15 times 1750, and that's the cost of the truck. Well, two things jump in there. Number one, if I have more jobs throughout the year, then I can allocate that 1750 is too high of a number. I now have more jobs to allocate it across. Number two, if the job that I'm allocating that took 10 hours, if it's a job that should have taken 5 hours, then I'm over allocating the truck. The truck portion of it was not where I went wrong. The truck allocation has nothing to do with the problem on that particular job. So those averages tend to hide the problems. And that's why I think people look at overhead reports and job cost reports that have overhead associated with them. And I think they internally, or in some cases externally, dismiss them because they don't make sense. And I have to tell you, they don't make sense to me. So I like to look at revenue and deduct direct costs, that's cost of sales, and then deduct direct overhead to find what in essence is my contribution margin. Now I know a number that's left to fill up all of my fixed expenses. My truck that we mentioned before is a fixed expense. Whether I use it on one job or 15 jobs, I still have the lease payment, loan payment, depreciation, the maintenance, the fuel, all of that. So I like to just look at a contribution margin number and know that that's what I have left over to cover all of my fixed costs. The beauty there is that that's sort of the reverse, the corollary of my break even. I know that now that all my fixed costs, including my truck, I need to hit this certain number every month to be profitable, to at least break even. And we think there's real value in just knowing those numbers rather than hiding it in some allocation on a job cost report. Happy to deal with any comments around that. Happy to deal with any alternative concepts. I love to talk about it, but that's, we're sort of the direct cost, non-variable overhead folks.
If somebody new to this, what's the easiest way to figure out the break-even cost?
So the first step is to determine which of your costs are fixed and which are variable. And don't overthink this. But in general, if the expense varies with revenue, usually, and you can adjust that expense. The more important piece is if your revenue goes down or up, you can adjust that expense, then that's a variable expense. If it's a direct expense, it's going to be fixed in nature. Now, we know that rent or utilities, they do vary, they do go up, but they go up over periods of time. They go up not necessarily based on revenue. So divide your expenses into fixed and variable. Take your fixed costs and add that up as a number. Let's call that $100,000 a month. And then take your gross, all of your variable costs and understand a contribution margin. So let's say I have $100,000 in fixed costs, and I know that my contribution margin, which is sort of my gross margin plus any direct G&A expenses that I have, is 50%. Then I know that I need to sell $200,000 worth of work to net $100,000 in contribution margin to break even to pay for that $100,000 in fixed overhead. It's as simple as that. And don't make it more complicated than that. Because you don't need the answer to 3 decimal places. You just need to know it so that you can hit it. You know where you are most months and do something about it before the end of the year.
We started this conversation about 22 minutes into the podcast. So if you need to go back, go to the 22-minute mark and listen to that again. We do talk about a lot of high level stuff some ways. How do you take this high level stuff and then bring it down to a day-to-day operations for the guys working out in the field?
That was always a big challenge. That was always the hard part for us. Was we always want more data, and historically, to collect more data costs more money. It costs time to stop and fill out a form. It's not intrinsic to the people doing the work, whether it's your salespeople or it's your superintendents or it's the people working on the front lines. At the end of the day, they're exhausted, and they should be because they've worked hard. So getting them to stop and recap something or do something like that is like pulling teeth. And and historically, you've had to have a lot of paper to track it. You've had people in the accounting department to input it, and it's very expensive. So what we love about today's world is It's not difficult to collect that information if you think about it in a different way. Everyone carries around a supercomputer in their pocket called a cell phone, and the internet makes it available to everybody. So now I know where everybody is. And then I used to say, why don't you have a practice for all the job superintendents or the project managers to call the superintendent on the job or the lead and ask what went right, what went wrong, and what they need help with. Sort of a huddle concept. Spend 5 minutes and just recap the day. If you have that structure around it, then people get used to thinking all day long about, oh, I need to talk about this at my 5-minute huddle at the end of the day. I need to talk about this. And then everyone kind of knows what's going well and what's going not. But the beauty of AI is you could have AI make those phone calls. They could ask the same questions. They would, the person would speak into the response to AI. Those numbers would be, those words would be transcribed. And all that information would be sitting on the project manager's desk tomorrow morning, or more importantly, in a visualized dashboard to say, first go here, then go here, then go here, and then get your cup of coffee.
Yeah, we made it simple like that. It's like you need to talk to your estimator and all that stuff's computerized now, but you should know that we estimate this takes 20 hours or 20 total man hours. You got 5 guys, so it's 4 hours a piece or whatever you had to figure it out. And then we just wanted to know, we didn't bother them. If you did your estimate, that's great. And then, but if it didn't hit it, we just want to know why.
Yep.
And let's fix that problem first.
Yep.
And you get involved, like you said, you can get real deep down detail, but the guys, they just want to know. And then what that does is we didn't make the guys responsible. We made the working foreman responsible. Your job is if you didn't hit your hours, you need to find out what happened. So you're the one responsible. You're getting paid a little bit more anyway. You tell us what happened. We can fix that. And it might be a piece of equipment. We're going to go fix a piece of equipment. It might be we just estimated it wrong. That's okay. We need to know that too. But like you said, it's much simpler today than it used to be. But it's just communication back and forth.
And a discipline of doing it.
Yeah,
because
I'm
again,
doing that. Yeah, exactly.
I know at 3:30 or 3:24 or 3:17, I'm going to get a phone call and I'm going to have to fill it with 5 minutes of information. And I can't say everything went well, I have no problems, and I'll see you tomorrow, because we all know that's not how life works. So it forces everybody to just be more open with what's going on. In a period, we can do something about it. Now, I want to go back to something you touched on, which is that estimating piece.
Yeah,
we're still surprised at how many firms don't have a discipline of going back and reviewing the original estimate compared to the job, or reviewing the original estimate process. And they do a good job of doing the job profitability, but not necessarily the estimate analysis accuracy or the estimate accuracy portion, because that's where the real magic happens. If you know that you can be a little more competitive on certain cost codes, that could be the difference between getting a job or not.
Mm-hmm.
If you also know that certain cost codes are sacrosanct, you know not to get involved with something that's going to be a nightmare and a problem for everybody. And you may be in a position to take that job over when the bid winner or the contract awardee has to leave because it's so unprofitable, and you can come in and fix things. So knowing where you can be in the marketplace from that estimating engine, and having that estimating engine be very, very, very detailed, that's a real strategic advantage.
You also talk about uncovering blind spots, financial blind spots. What are those, and how do you identify them?
So, we've been through a period in the last few years of high inflation. Prior to that, there was not a lot of inflation. So people got sort of used to things going up by 1 or 2%, or down or 1 or 2%, which that's not a lot of variability in financials. But we've had a serious amount of inflation in the last few years. And so the issue is understanding my sales went up, but how much of it went up by unit volume or contract volume versus raising prices. And so that's number one. That sales going up by 10%, but inflation going up by 15%, it's kind of a losing game.
Mm-hmm.
So after that, the main financial blind spot is cash. People often forget that if you sell on credit, and most people do, that if your sales go up, your cash goes down. And intuitively, you can kind of get through that. You kind of understand that. All right, well, I need to I become the bank for a little while, and then I collect that money. But the more sort of hidden corollary is when sales go down, cash goes up. So everyone looks at cash going up because I don't have any new sales that are on credit. I don't have any new jobs that I'm extending credit for or working capital for. So all I'm doing is collecting old jobs, and that cash balance goes up as a result. So very important to understand, if you look at things just from a cash balance perspective or a cash in the bank perspective, that can be a real hidden blind spot there.
I like income statements, profit and loss, whatever you want to call them. I even like balance sheets if they work. I mean, I like looking at them. The cash flow report, I've always struggled with understanding it. Can it be simplified or explained in a way that
we've been trying a long time to do that? You nailed it. You nailed it. Income statement, profit and loss, everybody understands. Balance sheet, they can kind of wrap their head around if it's done right and it's explained well.
Yeah.
The cash flow statement that accounting puts out, it's horrible. It's horrible. It's valuable for outside investors, but it's not necessarily valuable for internal use. And there's just a lot of jargon around it. So we look at it in this sort of simplified way. It's usually broken up into 3 areas. One tends to be more about your operations. Here's my profit and loss, and now I'm going to adjust it for things that happen on the balance sheet. So if I have a trade show that I'm going to go to in September, let's say, and it's February that I make the deposit on the trade show. Well, if I'm on the accrual basis of accounting, then I'm not going to recognize that expense until October, but I'll have the expense. I send the cash out in February. So I need to adjust on my balance sheet for that prepaid expense, if you will. So my profit and loss doesn't show that number, but my cash isn't there. So I need to adjust for those balance sheet type items, things that I either pay in advance for or things that I'm currently experiencing expenses for, let's say that trade show in October, but the cash has already been paid for. So I need to adjust my profit and loss for those balance sheet items. And then there's things that relate to investing in the business. Those would be fixed asset purchases or dispositions or intangible assets or other things around, look, I'm buying 5 new trucks. I'm going to use them for the next 5 years. So to look at my investment activity this month and know that I'm out $1 million for 5 trucks, that's not really representative of my business. It's and the income statement only has 1/60th of that in depreciation. 5-year depreciation, let's say, and 12 months, that's 60 months. I take my $1 million spend divided by 60, that's my depreciation roughly. So I need to adjust for those things that I did to invest in my business, financing and investing activities, or cash that I generated by selling things that I can no longer use in my business. You can generate a lot of cash by selling stuff, but if you sell stuff that you use to make money on, you can't make money on in the future. So that's the nature there. It's to kind of give an outside person an understanding of what's really happening in the business. And then the final one relates to owner's equity or the investment side of things. If I bring in a loan, if I sell stock, if I bring in an investor, if I take draws, if I do capital distributions, anything that I'm doing around the equity section, that's the third part of it. So it's really breaking up the cash flow statement into the operating activities that result in cash, let's call that free cash flow, and then the other things around cash I'm using to invest in the business or divest in the business, and then in terms of assets, and then the final one is what happens on the equity, what happens left over, what happens when I send money out or bring money in.
So I talk about money trees, and the money tree mainly is your first business, and that's generating cash. And you take that extra income, what we're talking about, and then you invest in other assets to create another money tree. So is that conversation done like through these reports?
Well, it would depend on whether that other money tree sits inside your organization or outside your organization. So if it's inside the organization, then that all gets handled on the balance sheet and the P&L to see what those different money trees are. So that becomes different classes, departments, locations, business units, or if you set up a separate business, then that becomes 2 businesses run side by side or 2 financials run side by side, and then you consolidate those 2. You put the 2 numbers together, handle any intercompanies, and publish a consolidated report. So a lot of people create different companies, different profit and loss statements for different areas of their business, but they often don't consolidate them into an overall view. So they have a picture of how it works, but they don't necessarily have a picture of overall how it's working all together. And then finally, if it's done outside of that completely, if it's a different personal entity or a different vehicle altogether on the personal side, that just flows out through the third part of that cash flow statement that I talked about. So you have your profit and loss, your balance sheet, and then that third section of the cash flow would be where that money went out. And you don't really know if it went to personal expenses, repaying something on the personal side, or investment in something outside that has nothing to do with the business.
Can a CFO help people like that, or is it your tax accountant, or a combination of
It's
everyone?
It's a team. So the CFO stops at the organization, and usually most CFOs don't get too involved in taxes because of the complexity. But everyone needs good numbers. Everyone needs current good numbers, and more importantly, they need good projections to know what to do by the end of the year. And remember, accounting, their task is to take what happened and account for it. So they're not always comfortable with what's going to come. And that's where the finance function happens. The finance folks, we love just taking any number and trying to figure out what's going to happen to it next. That's how we're wired. So we create those good projections, and then the rest of the team, your personal financial advisor, if you're involved in the business, your business financial advisor, which could be any number of things, including the CFO, all need to get together. The tax portion of it, either the taxes for the business if you're a C corp, or certainly taxes for the individuals or the owners if you're a pass-through entity like an LLC or an S corp. And everyone needs to work together. Insurance plays a big part of this as well. There's a lot of different areas to be looked at, but it all starts with good numbers.
That being said, I've talked to a CFO a while back ago, and he had a opinion. I'm going to ask your opinion. At what level, whether it be sales or profits or whatever, at what level would a company benefit, or not necessarily benefit, but be the time to hire a CFO as part of their company, whether it be as a consultant basis or a full-time basis?
Yeah, the smaller you are, the harder it is to hire a full-time CFO. And it's for two reasons. Number one, you don't need it all the time. And number two, most CFOs want to be involved in larger companies and do more mind-expanding things, lifelong learning. They want to have that opportunity to expand. So it's hard to attract a good CFO to a company that's not able to use their talents on a regular basis. You're not raising money every month. You're not going, you're not planning to go public. You're not planning on doing a lot of those things. So that introduces the concept of fractional or part-time or virtual or any of those numbers you can look into. But the rough guidepost is $1 million usually. If you hit $1 million in sales, chances are you're starting to lose track of your informal ways of doing it. The real answer is when your informal ways of running the business aren't working for you anymore. That's the real answer. But I think around $1 million. We get introduced to companies at 5 million, 25 million, 50 million that don't have a CFO. And is that a problem? No. Could they have used one earlier? Probably. Could they have gotten to $50 million earlier? Perhaps. Could they have gotten to $50 million with higher profitability? I would argue they could have. But every business is a little bit different. But there's no too early time to start talking about things. It's just under $1 million, your business doesn't move quick enough to be able to take advantage of it. So those tend to be more quarterly or half year or yearly engagements. But for the month over month CFO level review the numbers, understand where we are, understand where we want to go, figure out how to measure them, understand all of that movement. $1 million to 2 to 3 to 4 or 5 million, somewhere in that range is a good time to invest in that.
Awesome. Well, thank you very much. Your contact information will be in the show notes. That way they can reach out to you.
Wonderful.
So that's the fun part. Now, you are one of those fractional CFOs, right, that could consult for multiple companies. Is that right?
We do that. Our team does that for multiple companies. Yes. We love the smaller companies because they haven't learned too many bad habits yet.
I hear you. That's not a bad philosophy. And so, as always, in the show notes, you can get a hold of Ken. And also in those show notes, if you like what we talked about today and want to talk about being a CEO, needing a CFO, then reach out to me. My link's in the show notes for your free 30-minute consultation. Ken, thank you very much. I could actually sit here and talk to you for a long, long time, but we might bore people who don't like numbers as much as I do. So
Agreed. We'll let the rest of the people go. We'll keep talking.
all right. Thank you guys. We'll see you next week on another episode of Hard Hat CEO.